Last time we talked about Euro commercial paper on slide number 39. Today we want to move on to slide number 40. We want to talk about international bond. And there are basically two major categories of the international bond. One type we call that foreign bond. The other type we call that Euro bond. Foreign bonds are offered by a foreign borrower to the investor in the national capital market and denominated in that nation's currency. One example, let's say a Chinese company come to the United States, issue corporate bond, and those corporate bonds are denominated in US dollar. Then for this kind of bond, we would call that foreign bond. And this type of foreign bond, because it's issued in the United States, sometimes we call that Yankee bond. Okay, so Yankee bond is one type of foreign bond. And foreign bond, according to United States SEC regulation, and they would need to register with our SEC, so there would be a relatively high level of regulation. So it's more costly in terms of the issuing foreign bond in the United States. And there, another major category of the bond, the Euro bond, is a bond issue denominated in one particular currency, but sold to investors in national capital markets other than the issuing country. This means that we are talking about issuing this bond in one particular nation or a region where the denominated currency is not this particular nation or region's currency. And for example, if let's say a Japanese company go to Europe, issue a US dollar denominated bond in Europe, then this would be Euro bond, in the sense that we are talking about the bond denominated in US dollar, but was issued in a country or a region that is not United States. When this kind of thing happens, we call that Euro bond. Because this US denominated bond in Europe is not issued in the United States, therefore it's not subject to US SEC regulation. So Euro bond could be issued with a lower subject to a less amount of regulation, so it's much cheaper to float this kind of the security. Okay, as a result, in recent years, that Eurobond has been very popular because the cost of issuing Eurobond is relatively low, and also the demand for Eurobond is relatively high. And the reason the demand for Eurobond is high will be in the next slide. Number 41, because Euro bonds are the so-called bearer's bond. They are not registered bond. Registered bond means that the SEC and the brokerage house, they have the information who owns what. So not much of the confidentiality. As for those really wealthy people, they wanted to somehow hide their wealth. On the other hand, for investors who invest in a Euro bond, it's much harder for other entity to track that particular ownership because it's a bearer bond. Bearer bond. Euro bonds are bearer bond. Bearer bond means that the ownership is established by actually physically owning the bond. You just put the certificate of those bonds in your safe, then, and don't tell anyone. No one will know that you own those things. So it has a very high level of confidentiality. Okay, next slide. And the for Yankee bond or the foreign bond in the United States, that the issuance of those Yankee bond must meet the requirement of the SEC, very much like the U.S. firm issuing U.S. dollar domestic bond in the United States. There's a high level of regulation, and so it's a little bit more costly for that issue. Let's move on to slide number 43. And for large company like Mercedes-Benz or like Toyota, sometimes they're issuing global bond. That means that this particular issue of the bond not just being sold in their domestic region, but also sold overseas at the same time. For this kind of large scale of issuance, we call that global bonds. Okay, really big companies, sometimes they issue global bonds. Next slide. And bond can be designed in many different possible ways. One example of such bond is a so-called dual currency bond. And the one example I have here, if you look at those periodic coupon payment from time point 1 all the way to n-1, those interest payments are being paid in Japanese yen. But the final principal at time point n was being paid in US dollar. So here we're talking about a mixture of Japanese yen and US dollar future cash flow. And in this particular case, you can design in any possible way. Okay, so it has a lot of unique kind of feature and quality, very suitable for the so-called financial engineering. Next slide. Sovereign bonds are those bonds issued by a national government. Okay, and so it's part of the national debt of many nations. And sovereign bond can be denominated in foreign currency or the government's home currency. Okay, so for example, Chinese sovereign bond could be issued in Chinese yen, or it could be issued in denominated in US dollar. It could be done either way, or denominated in Europe. Okay, and of course that is going to be a function of the different interest rate across different regions. And so often the case that they issue the bond denominated in one particular currency because the interest rate in that currency is currently relatively low, therefore they issue in that particular currency. And a sovereign government controls its own affair and thus cannot be obliged to pay back its debt. And also at this moment we do not have an international court nor that capacity to enforce honoring those promised cash flow. As a result, when a national government default on one particular issue of a sovereign bond, the bondholder cannot go to international court and ask the judge to say that no, would you please liquidating the one particular asset of this particular nation such that the money will be able to pay back to me as promised. And we don't have such a court, unlike the domestic bond issue domestically, that the bondholder, in the event of default, they can go to the court, and the court has the police power to enforce that domestically. But internationally, we don't have such a capacity. And the only way that one can theoretically argue that this could be a possibility is to send the military to force one particular nation to honor its sovereign debt. But as you may imagine, that no international military force would do those kind of things. So sovereign bond investor, often the case that take on an unusual level of risk because if one particular national government would not want to pay off its debt, then not much you can do about it. Not much doesn't mean you cannot do anything at all. Let's take a look at what happened. For example, in the next slide, this is what happened to Argentina. Argentina default $95 billion in year 2001. And at that time, 92% of the bondholder agreed to receive a haircut. That means that they get much less amount of money back. But 8% of that refused to receive a haircut, so they hold out. And those 8%, some of them are American investor, and they sued. They sued in the court in New York, and the judge in New York said that the Argentina ought to pay the money back to the investor. So the core of the New York, the older, the Argentina, all of the U.S. bank could not service Argentina. So Argentina basically had no access to U.S. capital market. And after that, Argentina simply was not able to issue any national debt at all. And until year 2016, Argentina came out enough money, pay off those bondholders that all the money way back 2001. That was 15 years later. And after that had been cleared, eventually in the year 2016, Argentina started being able to go back to the international capital market. And Russia is another example. Russia default a few years, like way back now, I cannot really remember how many years ago. And since then that Russia was not able to go to issue national debt internationally. And that's the reason why Russia currently has a very low level of national debt. Not because Russia would not want to borrow, but because no one is willing to lend the money to Russia because the poor record of the defaulting and not paying off all of the bondholders. So this is a sovereign default. Next slide. And just like any kind of domestic bond, the international bonds also receive credit rating. And Fitch, Moody, and S&P are the three major credit rating agencies. And for credit rating, they're focusing on default risk, okay, and not exchange rate risk. Default risk means that the probability that the issuer won't be able to honor the interest payment and the principal repayment. And for sovereign debt, okay, the debt issued by a national government, and the credit rating is largely relies upon the political risk, economic risk, and also the finance of the national government in terms of repaying back the interest and the principal. And for example, the current rating of Brazil is basically junk bond rating, just because the economy of Brazil had not been well for quite a few years after the Olympics. Okay. Next slide. And Eurobond market. Eurobond is a very large market. And so let's talk about Eurobond market a little more in terms of how to do, what kind of thing happen in the primary market, and also what kind of thing happen in the secondary market. Primary market is where that the new Eurobond is issued to the general public. And the method of the Eurobond issuance is very similar to the underwriting practice in the United States. Okay, and the underwriting activity is anchored by an underwriter, and this underwriter usually is a well-known investment bank. But this underwriting activity usually is shared by a consortium of the banks. So together they take on this particular issuance and to share the risk and share all of the activity and effort. And once they have been issuing to the capital market, the initial investor would be able to resell their bond in the secondary market. And the secondary market of the Euro bonds is basically a so-called OTC market, over-the-counter market. Over-the-counter market is a dealer market, is usually hooked up by a network of a computer. And it's not an exchange. An exchange has a centralized location for trading, while the OTC market does not have a centralized location, and the transaction is done through a system of the computers. And the major Eurobond market is located in the OTC market of the London. So London is where that you see a lot of trading of the Eurobond. Next slide. Let's take a look at primary market. So let's assume that IBM wanted to issue a Eurobond denominated in euro. Let's say that it's going to issue in Germany, okay, and the company is going to hire investment bank for doing that. Let's assume that it hired Deutsche Bank, and the Deutsche Bank is going to look into the issuer's situation, and then would also talk to the regular investor of Deutsche Bank in Europe and say that we have this particular issue of the Eurobond. What would be the kind of the yield that those investors would need to earn in order to compensate for the investment risk that they will need to bear? Once they do this kind of roadshow, getting kind of interest for purchase, and then they are going to set the price with the issuer and bought this entire batch of the Eurobond, and then quickly resell this batch of the Eurobond to its retail investor, to its regular investor. And this entire process is a so-called underwriting. And the selling, this selling activity usually will be shared by a few, maybe half a dozen of the investment bank or commercial bank. And so this is what we call the activity of the syndicate. So a syndicate of the bank is formed to sell that, and is led by, for example, one major investment bank. And this major investment bank is the manager of this entire consortium. And next slide. Okay, and those banks, okay, are going to earn something, and the revenue to those banks are the so-called spread, or sometimes called that discount. It's typically about, today is about 1%, sometimes for large issue is about 0.5% or even lower. And this spread becomes smaller and smaller because the size of the issuance becomes larger and larger. And this is a way that it has been priced. So you bought, for example, you bought at $1,000, you sold that at $1,010, then you earn that 1%, $10, and that's the difference between the price you pay and the price that you sell is the spread. Next slide. And for those investors, let's assume that an insurance company in Switzerland purchased this particular Eurobond, holding this Eurobond, say, for a couple months, and decides, say, that I don't want to hold on to this Eurobond anymore, I want to sell that. Then often the case that they pick up a phone, go to a couple dealer, and ask them that what price that they are going to buy. And those dealers are the market maker of this OTC market. And the majority of those major OTC dealers, they are located in London. And if then you pick a price that you like, that then you sell your Eurobond to those dealers, and those dealers will resell those Eurobond most likely to other investors. So that is what happened in the secondary market. That is, there are the so-called over-the-counter market. And next slide. And we have one example here for the euro-denominated Eurobond. So we have a FedEx. This is a U.S. company, and they're thinking about that they wanted to do the expansion, okay, in Europe. And if the euro interest rate was attractive, then they give them tremendous amount of incentive to issue euro-denominated Eurobond, in the sense that you borrow in Europe, you operate in Europe, you earn euro in the future, and then use the money that you earn in terms of euro, pay off those euro-denominated interest and also principal. and that makes sense, in terms of the money you get, the money you spend, and the money that you earn. They are all in euro, and as long as the interest rate is attractive, then they will be very interested about doing this kind of Eurobond issuance, and particularly Eurobond issuance that nowadays can be done at the very least at a very cheap way in terms of the issuing cost, etc. Next slide. For international bond market, we have indices. The most popular indices for those international bond market are compiled by J.P. Morgan and Company. And J.P. Morgan has 18 national government bond indices, and those information are periodically published in Wall Street Journal. Next slide. And let's talk about equity market. International equity market, we have about 3/4 of the market are the so-called developed country, like Western Europe, Japan, South Korea, and Singapore, and those are the developed countries. The majority of the investment opportunity are in those developed countries. Those are large, well-established capital market. And next slide. We also have about 1/4 of market capitalization are in the so-called emerging market, like Brazil, like Russia, like China, and Indonesia. Those are the emerging markets. Emerging markets, on average, okay, if we look into a long period of time, they tend to have a higher economic growth rate. They are more risky, but they give you a little bit more rate of return for most of the time. And developed market, they tend to be more mature and less risk, therefore a lower rate of return. So these are the two major different kind of the market. And emerging market often been defined in two possible ways. The first way to define a market being the emerging market is that the income per capita in that nation is relatively low, or just somewhere in the middle level, and so that is one way that a market is defined to be emerging market. Another dimension that whether a market is an emerging market is about to what extent that that market open it up for international investing. You might have a market that whose economy affords its citizen to earn a relatively high GDP per capita, but if this market does not really open up for international investor, then it really doesn't relevant. So here, the reference, we call that investability. Investability is about to what extent that this national market open up to international investor. And different nations have different level of opening up its national economy, and in general, a developed nation is the one that basically opening up almost 100% for international investor, and the emerging market have imposed substantial limitation. And today, let's stop it here. We should be able to finish all the remaining slide when next time when we meet.